Widow's Peak with your host, Dana Holmes.
Hello everybody, welcome to Widow's Peak. I'm your host, Dana Holmes. Welcome to the episode 13. Today we're going to be talking about financial literacy, or financial 101 as I like to call it. Joining me today, I have in the studio a great guy, very, very smart, very educated, and well versed in this area of financial literacy. Is a great friend of mine, Dave Roberson.
Thank you for having me.
David, welcome to the studio.
Glad to be here. Finally make the Widow Speak podcast.
Hey, you've been a fan of ours since the beginning, or I would say of mine, since the beginning, and I really appreciate that. There's been many times that I said this would be a good opportunity for Dave to join me, and finally I've been able to convince you, because you're always talking about money and how to save it. So I thought, what better episode to have you on than the financial literacy piece.
Well, I support the podcast. I love what you're doing. So any way I could contribute, I wanted to find a way I could, and looks like we put our heads together, and here we are.
Great. So David, tell us a little bit about yourself. Tell the peakers, we call them peakers, those who listen, because as you know, my audience is based on widows and widowers, but we also have young or married, single people listening as well. So I really don't think that our content excludes other people. It's just not hitting widows and widowers, but we do try to add a specific, piece to for those widows and widowers, because, unfortunately they've been thrusted into this new experience of being single and taking on everything. And I would say traditionally men normally have the role of the finance in the marriage, right?
Yes, traditional roles do play a part. But the one thing about financial planning and financial literacy is that it's a universal concept. So no matter if you are widower, single, divorced, because that's also a separation we have to really deal with real intricate financial ideas and concepts. It's universal. So we're going to have a good conversation today to kind of talk about a few different things that are on your heart, and maybe I can be able to help you and your audience.
I love it. And I really think so too, because you've helped me. So Dave, give me your background. Give me a little bit about your financial education, your background in financial services.
All right, so I will give you a little bit background just related to financial services. 10 years experience in the business as a financial advisor, a financial planner, most specifically focuses on retirement and investments. I have an MBA with a concentration in financial services from the University of Dallas Graduate School of Management. Also have a certificate in financial and estate planning, also from the University of Dallas Graduate School of Management.
Wow. Well, I knew you were smart.
I have some education. Yes, I do.
Well, that's why you've been so helpful during this transition for me. And I just bounced some things off of you, and you kind of like helped guide me, and put me in the right direction, and I take it from there. But I really, really think this conversation is going to be great for our listeners today. Are there typical things that you would say, maybe 3 to 5 rules to financial planning, or that a widow or widower should prepare for?
Rules, in real estate, like they say, location. Financial services, it's going to be planning. So not necessarily 3 to 5 things. So when it comes to the passing of a spouse, or even a separation or dissolution of a marriage, first thing that you probably have to do is determining what your immediate needs are. We have expenses that are ongoing, for example, rent, mortgage, so on and so forth. So cash might not be readily available And I think that's the first thing that an individual that suffers the loss of a spouse or a partner must sit down and figure out what's immediately available to me. Because the one thing that you're going to need to really begin to move forward is a death certificate, unfortunately. And until you get that and maybe some other legal documents, you might be in a position where you can't really make decisions. So paramount is what you have readily available so you can continue to live your life. But then once you get past that point, do you have the necessary documentation in place so you can begin to make some better financial decisions? I would say the second thing is you are now a single individual now from being partnered or coupled with someone. So now you have to recalibrate. What does your financial picture look like? What are your financial goals now? Because now you're in a different situation. And then most specifically, I want to say, which is really where my heart and passion most is looking at your retirement. It's easy to live day to day and live the lifestyles that we sort of desire to live. But there is honestly a reckoning coming when it comes to that age where you're forced to retire, because often we think that we can just work as long as we really want to. But when it comes to health, first and foremost, and then even age in the corporate environment, you have younger, cheaper talent sometimes. So you can't necessarily stay as long as you want. So you really have to be strategic about what does my financial life look like post-retirement? What does my retirement look like for me? So yes, we have a lot of immediate goals that we want to take care of, but you cannot take your eye off the end goal, because you have to have enough income in your retirement so you can live a reasonable life. And just a little tidbit, the average Social Security check is like $1,500. So ask yourself, audience as well, what would you do with $1,500 a month if that's all you had to live off of? Which means it's incumbent of you to have more for yourself so you can supplement that if it's even available, which I'm pretty sure it will, but that's not something you can count on or should expect. So what are you going to do in order to prepare for that time?
Wow. That is something to think about. That's definitely something to think about. So with Social Security, understand that Social Security, tapping into that for yourself, typically, if you're a widow or widower, then you also have the Social Security of your spouse.
Correct. So yes, if you have been married for at least 10 years, you get the higher of what your earnings benefit would be when it comes to Social Security or your spouse's. So again, if sticking to typical gender roles, whichever one has had the higher income over the course of their working career will typically have a higher income, and that's the one that any particular spouse or surviving spouse can take advantage of, that particular higher income.
You know, and talking to some other widows, you're not really aware of Social Security. Like, we all started working when we were pretty young. You started paying into it. You hear over the years that there's not going to be any Social Security benefits left for, a certain, I guess, generation.
Sure.
Right? And we also assumed, I believe, that Social Security either would be, if you lost your spouse, that you would get both.
No.
No one ever talks about that until you get to this point.
Absolutely. Again, I focus a lot on retirement planning, but the reason I do that because for most people, it seems so far away. And so the reluctance or the reliance on Social Security also is something that seems so far away. I mean, I still have roughly 15 to 20 years left in my working career, but because of what I know, I'm keenly aware of that. But the average individual might not be. So again, when it comes to these particular topics, we don't necessarily work with financial professionals a lot. So therefore, these are concepts that we really are not knowledgeable enough about to know what's coming down the line or what we should be even preparing for or what the impact will be in our lives at that particular point in time.
So when should we start thinking about retirement?
Now. Matter of fact, for most of your audience, it's probably too late. So most of us have some catch up to do. And I think that's the reality, because the government also gives you a provision to play catch up. So once you actually reach the age of 50, you have an opportunity to put more away than traditional person, because they know that you may be at a point where you haven't done what you were supposed to. You may have had some losses along the way, or just have come late into the knowledge of saving for your retirement and 401ks and IRAs and the like. Wow. You may be in a position where you need to play a little bit catch up, and the government does give you an option to do that. With that said, it's never too late, but you got to really start early for the most part. It's one thing that I did when I first started working professionally, as I started to put away for my retirement, and it's been wonders for me and be able to not get used to that income before I've gotten too used for it, but got into a habit of saving money. And that's the real key to any sort of savings is time. Do you have enough time to save for the things that you are important to you? And when it comes to your afterlife post-work, you need to have a significant amount of money in order to generate the income necessary so you can continue to live even in a reduced lifestyle. But again, that's another adjustment that we're going to need to make at that particular point in time.
We can't buy those Fendi bags. We can't buy that Louis Vuitton, those red bottoms.
You may need to cut back on some of those things. You may not need to deprive yourself, but there is an opportunity cost, so to speak, with living a certain lifestyle. One of the things that, for example, Dave Ramsey has this saying that I really like this saying. He says you have to live like no one else so you can live like no one else. And what that means is you can't live like the Joneses today in order to have the retirement that you really want, because you have to save a lot of money to make those two meet. So you have to be willing to cut back a little now so you can live better later. And again, later is so far off for most people, and the lifestyles, the things that we want now are really more important because we want to look good, we want to drive good, we want to live good.
Right.
But that typically can come at a cost to later on in life, because you have to realize with the advances in medicine, people are living a whole lot longer. So if you're going to averagely retire at maybe 65, a woman could actually live another 20 years post 65. That's 20 years without income. Most people can't go 2 months without income.
Right.
How are you going to go 20 years without income?
Yeah.
So again, you may have Social Security to help supplement it, but that's what it's supposed to be, a supplement. And so that's why it's more important to put those focus on those things for later. Still enjoy life now, but there's two lives that you need to enjoy while you're accumulating and post-retirement.
While you're accumulating post-retirement. So when you say the government allows you to catch up, what does that mean? What do you mean?
So in your 401ks or your pre-tax savings at your employer, or even in IRAs, there's limitations on how much you can put in those counts on an annual basis. When you reach a certain age, you're allowed to put more, because again, you're at a critical point where you're in the last maybe 10 years or 10 to 15 years of your working career to allow you to play catch up, so to speak, meaning you're behind. I mean, the term catch up specifically means you are behind. So it gives you an avenue to actually play catch up and put more money away than you typically would be able for the average person.
Wow, that's good information, Dave. So do you recommend? You know, we're I guess we think typically a widow is a certain age, but widows actually, 20s and their 30s,
Correct.
So it's not just people that are facing retirement. And so we may be talking to a millennial, that's a widow. That's, I think I know one, but they are in this age of, spending, or they might be an entrepreneur. They're not thinking about retirement at all. So what are those avenues? What are those entities that they could actually kind of put their money into in order to get started?
For anybody getting started, I mean, the name of the game is savings. Whether it's in a traditional bank account or account designated for retirement, it's an investment account, it doesn't matter. The end goal is putting money away, and what you want to get is, how can I get the best return on the money that I have saved away? So in the interest-bearing account at the bank, you're getting less than 1% on your savings. So realistically, that's just a place for some emergency cash, something that you have quick access to. The next level is, how can I increase that? So now you have an investment account. realistically, you're putting money away in both stocks, mutual funds, maybe some bonds, some bond funds. The ultimate goal is you're trying to get a higher return for the money that you're putting away. So there's many vehicles to do that. Some are more advantageous from a tax standpoint than others, but ultimately you want to get in the habit of just putting money away. So even if you're not considering as a younger person, retirement is so far off, but you still have needs. For example, you may want to, again, even moving to an apartment now costs you so much money.
Yeah.
So if you're moving out of your parents' house and you want to get into your own place, well, that's going to cost you. You're going to need to put some money away to do that. So you're typically going to do that in some sort of savings vehicle. If you want to start a business, you want to put away some seed money so you can do that. You're going to put that away in some account, some interest-bearing account, or anything that's going to allow you to increase the money that you're saving. Again, you're looking at your retirement. You want to put your money away in vehicles that are going to allow you to take advantage of compound interest or just the rise and fall of the stock market. So different vehicles for different things, but ultimately you're putting money away. You're trying to get the best return on it while it's in that particular vehicle to order have it available for you at a later time. So the key is having a savings mentality. And that's where the challenge is for not just us as African Americans, but I guess really for our country as a whole. We're saving less. And we're spending more. It just, we have to get to the point where we start to, again, putting plans in place for certain things. There's a lot of things that we need to do or want to do, such as buying a home, but it takes a considerable amount of money for a lot of people to put that money away for your down payment and your closing costs, so on and so forth. Where is that money going to reside while you're putting it together and ultimately to you at the point where you can actually put that down and secure that mortgage?
Right. And what are the typical things, like, why are we so afraid to save? I think, you hear that my money isn't accessible, right? So I put it away, but I don't have access to it. And, 401ks, that was, that used to be dollar for dollar match. There was a time where that really helped you save for retirement.
Right.
And companies had pensions.
Correct.
Years ago, and
Right.
they're doing away with those. So you're really dependent on those savings. But I know some people are afraid that they don't have access to it. I know with COVID, some things have become a little more relaxed. You're able to borrow from it without penalty. It's like.
Yeah, so the reason that exists is because it's for your protection. These are retirement funds. Now, you could have a circumstance where you need access to money, and typically that might be the place that has the most funds for any particular individual, so you would want to access them. But it's going to depend on the employer and the particular plan what provisions they make available for access. Some make provisions if you have a hardship. So for example, if you're facing eviction, as long as you can show them proper documentation, they might allow you to take a withdrawal. Some plans have loan provisions, so you can actually borrow against your own money, take money out, pay it back in monthly installments over a particular period of time. So there are different provisions, but the reality is they're wanting to protect that money because it's earmarked already. It's your retirement money.
Right.
It's not your emergency fund, which you should have an emergency fund. So there are different funds for different things, is what I kind of alluded to earlier. Yes, you should be saving for your retirement because it's important. It's going to take quite a bit of money to really have a really decent lifestyle in the retirement. But those provisions are there to safeguard you, but they may be accessible in certain circumstances, depending on your employer, depending on your plan. If it's an employer plan. Again, if an IRA, there's no restrictions. That's your money. You can take it out, whether it's traditional or Roth. Then you determine whether you have any penalties for taking that money out. But different plans for different things. What is your goal? Which I'll go back to our first question. You have to recalibrate. What is your plan moving forward for you? What do you have now? Where are you trying to go? And then put those things in place and start to move forward.
Dave, when I hear from some of the audience and the peakers, they talk about, things happen so suddenly, I didn't even know where to look. I don't even know where the money was.
Right.
I might know about an insurance policy, but a lot of people especially our age, we change jobs, right? So you have pensions that still may exist out there.
Sure.
How do you even start to unravel that?
Unfortunately, there's no easy way to unravel that. So, I mean, you alluded to earlier traditional roles where maybe the man is sort of in charge of the finances of the home. That's really not the way to move forward now. Everybody has to be intimately involved to a certain extent. Even if you're a single person and you have adult children, they need to they need to have some sort of knowledge of what's going on. And I've heard this maybe a couple of months ago about having a household email account to where you're not just having everything.
To my show, Dave, I did have a show that was called Password Protected.
Right.
It sounds familiar, but go ahead.
Yeah, I mean, having that household email account where all the bills go, all the financial emails, the confirmations, that's one thing, because that gives that spouse an opportunity to go in, read, and just catch up. Here's what's going on. This is where this is located. But you really should have it documented in some form or another, whether it's electronic or even just written out on paper.
Right.
You should have an accounting of your accounts, all your financial business. That's why I kind of love these apps. Right now, for example, I'm an avid user of Mint because I have access to all my accounts. I know where everything is. If I had a spouse, they would know that information. And again, it's all right there.
It's all right there.
So for a lot of people, it's going to be a treasure hunt.
Break down Mint. I know about it, but for some
Mint
people.
is an Intuit company who also makes TurboTax. It's just really accounting software for the individual to track your expenses. And that's mainly the biggest thing that I take from it is you get to set a budget, you get to track against your budget, you get to set goals and track against those goals. So number one, you see exactly where your money's going, what you're spending on, all those subscriptions that you have, Disney, HBO Max, Netflix, so to speak. You get to see it in real time. You know what? We're paying a lot
of money out.
Yeah, as long as you know. And again, if you look at your expenses, you get to see, wow, we're spending money in places that are not beneficial for us, that we need to sort of cut back on or cut out. So it gives you a picture of your finances. It gives you a picture of where all your accounts are, what your net worth is. So now at a glance, you can see how you're doing financially, which is the biggest tragedy for us, is that we know we don't want to know sometimes.
Right.
And so we just keep moving, making money and spending it, keeping our head sort of buried in sand, so to speak. But when you keep track and have something to kind of go back to and reference, it makes you make better decisions.
Yeah, you're right. I used Mint. I started using Mint probably, back in maybe 2010. And it really does give you that one-stop, like, shop and glance of everything. Right. It tells you about how much interest you're paying on your credit cards. Fees. Fees. It tells you, like, how much you could typically save if you were to pay it off, or how to even accelerate payoff for things. Right. And it really, really gives you that. I mean, it's that financial picture that, like you said, you sometimes may not want to know. You may not want to know.
Again, so during my time as a financial advisor, that was one of the biggest challenges I had in terms of acquiring clients, is getting people to face up to where they are. And people are embarrassed about the income they make. They're embarrassed about not having savings. They're embarrassed about not living on a budget. So there's a lot of things that prevent us from working with professionals, which we all should do, whether it be an accountant or a financial planner or a state attorney. These are professionals that really can help us. So even when it comes to wills, and we're going to talk about that a little bit later, these are things that are needed, not only within our community, but just universally. And no matter what your status is, again, you talk about married, you're a single person, you need to know. Right. And you need to have these things available to you.
Is a financial planner, are those individuals expensive?
No, there's different fee structures. More or less is you're either going to be charged a flat fee, or it's a position, part of your assets, so to speak. So it's all about assets under management. So you have a certain amount under management. There's a commission off that. So it's really fees and commissions. It's not expensive. Again, these are things that we don't want to pay for. They're professionals. If you have a tax situation, instead of going to H&R Block, you might want to just actually go see a CPA. And really, again, if you're in trouble or if there's something that you really need some help with, we will rarely pay for attorneys. Again, from a criminal standpoint or maybe a lawsuit standpoint. Right. But when it comes to what you are financially, and you want to make sure that your assets pass on correctly, then you want to see an attorney and get that will drawn up so you can have really final say in what happens to you when you're no longer with us.
Right. Yeah. I think as a people, and we're not just, we're African American, but not every listener. We feel like that's for rich people. We don't want everyone in our business, right? And so people don't want.
Professionals are for professionals. So again, we're talking about personal finance. This is a very important topic to where there really is no shame. You have to be responsible and you have to be accountable because money is just too important. Right. And even when you're gone, it can also leave a huge mess for other people to deal with. So, I mean, I understand some of the apprehensions that people have, but these are some of the things that we just have to venture out, start asking questions, and the more you learn, the better off you'll be. And that's just where it starts, education for the most part.
Right. So those accounts, and they can be, like you said, the 401ks, you got the IRAs, you got the pensions and this and that. And then, like you said, the wills, right? So we don't typically have wills, especially young people, because we think we're going to live forever. And I know that's not your wheelhouse, but as much as you can share, like.
Well, I think everybody has something that they want to pass on, even if it's only a few hundred. I looked at my son's, I had him set up an IRA, and he has his little beneficiary set up, and he has his sister listed. So he's going to have a few $100 in there right now.
Wait. He listed his sister? Okay.
I'm not offended.
You're not offended? Okay. All right. But good. Okay. Yeah, as long as he didn't have a girlfriend.
No.
Okay. All right.
Because everybody has something that they can pass on. The question is it going to go to that person in the manner in which you desire it to? Okay. And that's the biggest thing. So if you do not have a will, you're going to pass away in what we call intestate. That's without a will, which means the state decides what happens to your assets.
Say that again? It's called what?
Intestate.
Intestate. Okay.
Yeah. So passing without a will. So that means the state decides what happens. So when we talk about certain accounts like insurance policies or annuities, these are contracts. They don't go through probate. You have a designated beneficiary, they go directly to that individual. So one of the things that's going to be important for, again, getting back to your core audience of widows and widowers, is on those accounts making sure you have beneficiaries designated and they've been updated. And that was one of the biggest tragedies that I saw when I was working in the business, is to have someone pass and have an old spouse listed on the policy.
You said?
Yes.
You said what?
An old spouse listed on the policy as the beneficiary. Okay. It happens.
Okay.
Because, again, not meeting with your professional or not being aware of some of the things that you need to, you kind of let these things go. But beneficiary designations are important. And as your life changes and the people in your life change, you need to change those beneficiaries as well. Right. So if you have bank accounts typically, you can have what we call a transfer on death provision. Where it transfers based on your debt, but that's something you have to add. Your typical bank accounts don't have those. So again, when we talk about needing access to money, if you're not a joint person on that account, then you have to go through the legal process to get access to that account, unless there's a transfer on death provision. Every account that you have, if you're able to have a beneficiary, you need to have one and make sure those are up to date. On those ones that don't have beneficiary designations, you can do transfer on death. You can do that with real estate. You can do that with a whole lot of things.
Wow, Dave, you're going to have to leave a whole list, because I'm going to get some requests about this. And I have a resource tab. And, people can go back based on our show and the information
Sure.
that we have, and certain terms like we're not familiar with.
Right, I understand.
So
Completely.
this is going to be great.
Yeah. So I just to recap just a little bit, again, a life insurance policy, that is a contract. You can have beneficiaries that don't have to go through probate court. That person has direct access to their money going through that administrative process. 401ks, IRAs, annuities. So those are contracts.
Okay.
If you have beneficiaries, they go to those individuals.
If you don't,
then those are subject to your
probate.
estate.
Okay.
Yes.
Okay.
And then your estate goes through probate.
Okay.
Which means they'll be subject to your will if you have one, and it has to be a valid one, which is another thing. If it's declared invalid or you die without one, then the state decides what happens. Which now brings in your parents, your siblings, your children. Certain circumstances, everybody could get a cut, depending on the state that you live in.
Okay. Okay.
And that might not be your wishes. So
Right.
if you have specific wishes, now we have to sit down and talk with someone about what do I want to happen with this pot of money? Where do I want it to go? Who do I want to help? Who do I want to be a beneficiary when it comes to these
And
things?
see, and this is important for this stage because our listeners typically are the widow or the widower. So they are now single, right? And I'm sure they all had their spouses on everything, or a percentage goes to the children, but that has changed. So now either if you didn't have children, who does that money go to now that your spouse is no longer here? If you have children, how is that percentage now going to change, right? Because the
Right.
spouse is no longer on there.
Sure.
It really, really would be complicated without.
Yes. So if a married couple has children, so if one has children outside the marriage, they're treated differently than children with the marriage. So again, it gets complicated.
Yeah.
Again, you're depending upon the state laws to say what happens with the resources if you don't designate properly.
Yes, wow. And see, and a lot of people think, well, I don't have that much. I'm just a working class person. I don't have that much in order to go out and get an attorney to draw up this will because the will is going to be expensive and, the beat goes on.
I mean, wills don't have to be expensive. Again, there are, for example, LegalZoom is one that'll help you actually draw up a will. And the thing is, for wills, they have to be declared valid. So you want to make sure that you go through the proper channels. Even though you have different types of will, you can actually write out a will on a napkin. But as long as it's witnessed, that may be valid in a court of law. So there's different things you can do. Again, yes, sometimes it costs to seek the counsel of financial professionals or even attorneys, but that's just something that we have to do as individuals. We have to make sacrifices. And not necessarily a sacrifice, because if we really talk about, again, some of the things that we do spend money on, we have no problem. But the minute we talk about certain things, it's, well, that might be too expensive. It isn't, not really.
Right.
Just
Right.
take a look.
That HBO Max is getting expensive. That's what's expensive. You look at all those subscriptions. You could have had a will. You could have had some annuities. You could have had some stocks, some bonds. You know what I mean?
Right,
Yeah,
absolutely.
Yeah, So should you put all of your eggs into one basket? Should you just have one financial institution that handles all of that? What's the advantages, the pros or cons of that?
All right, the proverbial eggs all in the same basket. Once upon a time, long time ago, our parents and our grandparents and great grandparents did trust banks, because obviously, at some point in time, banks had the opportunity to fail. That's just not where we are anymore. We have, for bank accounts, we have FDIC, Federal Deposit Insurance Corporation. There's a certain amount of money you have that's protected by the federal government. I think it's $250,000, but don't quote me on that. But again, you have protections.
Yeah.
So we're not really in an age where institutions will fail. So the whole adage of putting all your eggs in one basket means, from an old school standpoint, having it in an institution here, as if that's adding some safety.
Right.
Not really.
Okay.
So what we're looking at is, how do you make your life more administratively easy? If it works to have all your accounts at one or two financial institutions, then that's just the best place for it. Okay. Not necessarily from a institution failing standpoint, but again, if you're working with a professional, that's easier for them to know where your bank accounts or your financial accounts are so they can help you. So there are more pros with dealing with one institution or a small number as opposed to quote unquote spreading your money around, so to speak.
Okay, and that right there, I was actually asked that question, like, Miss Holmes, why do you have everything so spread out? I was like, and I'm like, I'm not comfortable having all my eggs in one basket. And I remember he said something about, the eggs. I said, I don't like them to be in one basket. I like to spread them out. And he said, but you won't be able to collect those baskets, or your family would have trouble collecting all of those baskets if they're not properly listed. So I chuckled when you were saying about the basket. And it's probably why, because I do remember my parents saying that. You know, I do remember my father saying, I don't trust my money just in this bank, because if something happens, all of that.
Yeah, but again, there are reasons to why, or advantageous to have it all at one institution, or again, a small number. Again, depending on the institution, there might be better incentives. So again, if you have an emergency fund, one bank might be offering a much better interest rate on that money than your current bank or primary bank. It might be a good reason to have that money over there. But for the most part, we don't have to worry about banks or institutions failing because we have federal coverage, and that's just not a reality in our particular day and age.
So what financial plans should one begin to set up after the loss of a spouse?
Realistically, the same ones that should have been set up before, but I understand that might not be where we are. So the financial plan is, generically as it sounds, it's just that. What is the plan for my money now? Whether it's my income, my savings, what I am inheriting or receiving from my spouse, or whatever the case may be. What is the purpose of this money? What is the goal of this money? What do I do with it? So if it's for short-term goals, it might be better suited here in this particular investment vehicle. If it's for more longer-term goals, it might be better suited here in this particular vehicle. And even within the vehicle, what types of investments I might have, whether you choose to do Bitcoin, which is a no-no right now, but stocks, the makeup, there's different things that we need to plan for, and that's what the plan is. The money you have, the money you plan to accumulate, what is the purpose of it, and where is it going? So it's if there's a specific plan, I'm going to always say retirement planning, because again, that reckoning is coming. And I keep using that word because I'm only saying that based on my experience. Yeah. We're not prepared for that. So yes, you're going to want to save for your home, which is great, because that's one of the best ways to accumulate wealth if you're looking to be a homeowner. Yes, those are intermediate plans, but again, what is the purpose of the money? What goals are you trying to accomplish? So it really is mostly goal planning. What do I plan to do? And then do I have the proper vehicles in place in order to facilitate that?
How about student loan? Well, I'm sorry, not student loans. How about savings for education?
Savings for education. So there are advantageous vehicles for that, the proverbial 529 plans. But those have to be used on expenses. The only reason I'm pausing is because even going back to when I was growing up to, I'm looking at today's kids, not all kids are going to end up going to college. And so you could potentially save money in a vehicle that's designated for education, but they never get to use it for education for whatever reason. So again, planning, what is the purpose of the money? You can always use, for example, a Roth IRA in a similar way. Again, if you start early enough. Again, so if you're starting when a baby's born, so to speak, you can actually...
we got to go all the way back to when...
because it takes some money.
I'm born, put that money in there.
Because of the limitations of the IRA contributions on an annual basis, it takes time to get money in there, as opposed to a 529 when you can put to whatever amount you want in there, more or less. So again, depending on what the goal is, but those are specific vehicles for saving for a child's education. There's a reason that they're there. You can take advantage of those. Again, what is the goal? And is the proper vehicle for that particular goal?
What is the goal and what is the proper vehicle for the goal?
Right.
Okay, I'm taking my notes. But that money for the 529, if the child doesn't go to a college or university, they can use it for any secondary education, trading school, but you could also, I believe.
Well, yeah, what penalty? So if it's not used for education, you can't have access to it, but with a penalty.
Oh, Dave, this is all good information.
Yeah, so these provisions are, we'll go back to what we said about the retirement account at your employer. It's for retirement. If you don't use it for retirement, there's going to be a penalty for it because we want you to keep it there. If it's for education, we want you to use it for education. You still have access to it, but to sort of curb your appetite for maybe pulling the money out for other reasons, we'll let you know that there might be a penalty associated with it.
Wow. Yeah, that government, boy, they like them penalties. So life insurance. So now you're rerouting, you're rethinking life insurance because life looks different for you. And so typically your life insurance was to cover your spouse in the event that they had to continue the lifestyle that you both were used to, maybe even take care of your children. But now with one spouse gone, you're now rethinking your life insurance. So
correct. So again, what is the purpose of the life insurance? There's a specific amount that you take on as far as a deathbed is concerned, because what are you trying to cover? Typically, you want to cover missing income. So you would sit down with a spouse, determine what their age is between that and retirement. What is their earning potential between that period of time? We want to make sure we have enough life insurance to cover that.
Right.
So with the passing of a spouse, now there's a recalculation, so to speak. If I continue life insurance on myself, what is the purpose of the life insurance? If it's just me, are you trying to cover adult children? Or are you trying to say, well, they're adults, I no longer have a need for life insurance? Or the amount that I had before, it's not that as important. Maybe I can reduce that down to save on the premium. So again, we're back to a recalibration. What is the purpose of the life insurance? What is I trying to cover? Do I still need it? Do I still need as much? And can we make some changes?
Okay. And I understand that you and I have had some conversations about life insurance and the children and things like that, but you're hearing terms of generational wealth.
Okay, yes.
Right, and legacy planning and things like that.
What is the purpose of the insurance? So if you want to start a legacy within your family, life insurance is one of the most cost-effective ways to do that, because you can insure yourself for a whole lot of money and make sure that if there is a passing, that money stays within your family, and that gives you the following generation a leg up to move forward. Can you imagine if we all had life insurance and after a couple of generations, there could be significant wealth in any particular family? Absolutely. So it's not all about accumulation, but we can also leverage the life insurance industry to affect that particular cause as well.
Right. Why do you think we don't? Why do you think we don't? For the most part, it's education. Secondly, do you trust, again, this is where we're going to get back to estates and trust, so to speak. Do you entrust the beneficiaries to do right with that money? If you have irresponsible children, so to speak, in your own eyes, maybe you are a little bit apprehensive in doing something like that. But again, here's where you can work with a financial professional, put some provisions in place. But again, you're looking at what do you want to cover, getting the education about it, because that definitely is an avenue for anybody to really start to accumulate money in their particular families over a course of several generations. Right. Yeah, and properties and things like that, leaving properties to your children as well.
So that's why it's important, again, based on the topic that we're discussing, if you have children, these are some of the discussions that you need to start having with your children and letting them understand or be educated about certain things, because these are things, for example, the best time to get life insurance is when you're young and healthy. It's the cheapest.
Okay.
You can get $1 million policy and pay maybe less than maybe $15 a month for it.
Wow.
Because again,
Starbucks.
Because you don't need it.
Right.
Because you're young and you're healthy. It's only as you get older and you have health conditions that it prohibitively can get more expensive. But again, there's an avenue there to definitely accumulate that kind of wealth, that kind of money based on using life insurance as a vehicle.
Right. Wow. Speaking of life insurance, because you're very helpful with like the term life, the
universal
life. You want to touch on that?
Briefly, yes. So
Okay.
at its basic core, we have either temporary or permanent insurance. Temporary is only for a specific period of time. Again, we talked about maybe covering the working years of a spouse to make sure that if anything were to happen to them, that life insurance would be in place and that money can be passed on. But there's also the concept of permanent insurance, and it's designed to be around that because unfortunately, when it comes to term insurance policies, less than 2% ever pay a death benefit. People normally outlive the term.
Okay.
You got a 10-year policy, you're going to most likely live another 10 years. And then maybe you may re-up and get another 10-year policy.
Okay.
So people typically outlive that term. But if you have permanent insurance, which is insurance for your lifetime, then you're definitely going to have a death benefit depending on the amount that you set up. So when it comes to the different flavors, there's different flavors of permanent insurance, which involves interest rates or investments.
Right.
Can get a little complicated.
Yeah.
They're mostly used as savings vehicles. But when you look at the financial hierarchy, saving money or accumulating money in a life insurance policy, there are other vehicles that you will want to use before then.
Okay.
Again, for someone in a different tax bracket, so to speak, who is exhausted or reached limitations with the traditional vehicles for accumulation and savings, may use a life insurance policy to carry on that same effect.
Okay. That's good. That was you simplified that.
I tried to.
You simplified something that took us 3 days to get through.
It's because you asked a lot of questions.
I was just testing you to make sure you knew what you were talking about. Taxes.
Yes.
Tell us about some taxes. Like, I mean, that's the fear, right? I'm gonna have to pay taxes on this. My tax bracket changed.
When you say taxes on this, you inherited?
Inheritance and properties and insurance and 401ks and all of that. Am I setting myself up for the government to come for me?
No. So in terms of the government, and we're talking about the federal government, that's only when it comes to state taxes, which is colloquially known as the death tax. That's for wealthy people.
Okay.
So right now, the exemption is a little over $12 million. The average individual doesn't have to worry about estate taxes.
Okay.
So the money that you inherit, especially like the 401ks or whatever the case may be, those are tax-free to you until you take money out. And there's different provisions based on different accounts. So in inherited money, most likely that's something you won't have to worry about from a tax standpoint. But since we are mentioning taxes, I think one of the things that I do see, even I had a period of time when I actually did tax preparation for Jackson Hewitt, we're looking to have large returns when that's really not the goal. In an ideal situation, you should want to owe nothing and pay nothing, but it's a little hard to get there. So more or less the rule of thumb is maybe you getting a refund or owing around $200 to $300.
Okay.
Anything outside of that, especially when it comes to a larger refund, you're really using the federal government as a bank, and they're a very, very poor bank because you don't get any interest.
No interest.
So you're better served having your, for example, your W-4s at work, adjusting those with the proper allowances so you can take money home
Right.
as you're accumulating it or getting paid and saving it and doing better with it from an investment standpoint.
But not looking for that big check.
Yes, you should not be looking for the big
Yeah,
check.
that following
Absolutely
year.
not.
Okay.
Absolutely not.
Okay. Yeah, because instead of getting that $5,000 from them, you could have had that $5,000 in your bank account accumulating interest.
And done better with it. Yeah, so if you're using the IRS as a bank, that's not a good idea.
You said IRS as a bank. Did we touch on will planning? Yes, we did. Will planning regarding finances. Yep. Opportunity.
So we just to kind of retouch on that, making sure you have proper designations for the accounts that have those designations.
Okay.
Again, considering your bank accounts, you can add a transfer on death designation. So you want to kind of take a look and see if that's something you want to do, because we go back to your first question is, you need immediate cash in the death of a spouse to continue. For example, the rent market is really, really crazy. And if you don't have your rent within 3 days, you got that, within a couple of days, you got that 3-day quit. So do you have time to get a death certificate, to get access to money?
Right.
So again, these are things that you need to sort of access up front, and even in preparation for those of us who are married and haven't suffered the loss of a spouse, am I prepared if that happens? What do I need to do? So again, having this checklist to go through all your accounts to know where they are, what provisions that they hold, and if they don't have certain ones, could we add them to making sure that the flow of money is expedient and efficient.
That's good, Dave. That's really good. What are some common mistakes or misconceptions people have about money?
Mistakes is not planning, not saving. And again, that is the number one thing, is our lack of ability to put enough money away for various reasons and sticking to it without tapping back into it for whatever expenses that we feel are necessary at the time. To me, that's the number one mistake that we make. Misconception, again, thinking that we can just work and earn income until we desire not to. We have to consider the fact that as the workforce ages, employers are making different decisions, and even health starts to really creep in at the later stages of life. Yeah. So you might not have control of how long you can work, whether it's not a debilitating, but maybe you can't stand up, or maybe you can't use your hands for long periods of time. That's going to affect your ability to earn an income and move forward. So just realistically understanding that you cannot work forever. What do I need to do to make sure that I'm saving? And I think that's the biggest things for me.
Right. And that made me think about there are various healthcare insurances, other things that are available for if you're incapable of standing or incapable of, or temporarily you might be down, but there's these different insurances. So employers are good at offering short-term disability and long-term disability. Not everybody sees the advantage of doing that because typically they're paid with after-tax dollars and people don't want to cut any more out of their check. But these are important insurances to have. And even if they're not available at your employer, you still can get disability policies through insurance companies outside of your employer. Again, you're more likely to suffer a disability than you are to die prematurely for the most part because of just the nature of life, vehicles, whatever the case may be. You could have a debilitating injury that puts you down where you can't really work anymore or have limited ability to work. A disability probably would definitely come in handy because you can't always rely on Social Security benefits because those are very stringent because you're actually telling the government that you can't work anymore. So you're going to have a history of medical tests and conclusions from doctors to support that, which a lot of us might not have depending on what injury that we might suffer or have. That's true. And you got to watch those exclusions too.
Yes.
To medical conditions and things like that. So there are additional, insurances and things like that. Well, Dave, wow, this has been an interesting conversation.
Yes, it has.
It's been very, very helpful. I know our listeners are going to get a lot of benefit from this. There are additional things that, like you said, that I now every time I have a show, I think of another show that comes from that. Digging deeper into Social Security and life planning and legacy planning and investments and all of that stuff. You mentioned those Bitcoins. And digging into that, what are those? What is the metaverse? My head is like, wow.
There are all kinds of investment vehicles. There are all kinds of savings accounts or accumulation accounts. It just takes a little bit of education, asking the right questions, and partnering with the right people, and you can definitely get through it.
Right. Thank you, Dave.
Very welcome.
When I thought about this, I thought financial decisions can be paralyzing after the loss of a spouse. What do you do with all of these accounts? What do you do with this information? Because a person during that time, it's hard to think.
Correct.
It is really hard to think about all of the checklist.
Well, that's why it's important, again, to the checklist, making sure all your ducks are in a row beforehand, because that is definitely not the time to scramble and make certain decisions. And upon going through the grieving process, it just can be insurmountable or overwhelming to have to kind of figure that out. But again, some of us are left in that position to where that's something we have to do. But at least I've equipped you with at least a little information so you can start that journey to kind of figure out what do you have, where do I need to do with it, What are my goals in life? Who do I need to talk to in order to put these into play?
Wow. Thanks, Dave.
Very welcome.
Thanks for your time. Will you come back?
I'll definitely come back.
To us?
Yes, I will.
Definitely. We're going to have you on another episode, actually.
Looking forward to it.
We're going to have you and another close friend. I'm just going to tease it a little bit. It's called Am I My Brother's Keeper?
Oh, I believe I know who you're talking about.
Yes.
I refuse to do a show with that individual. No, I'm just kidding. Looking forward to it, Dana.
Thank you, Dave, for your time.
Take care.
Many, many blessings.
Thanks for listening to Widow's Peak. For extended conversation, head over to our YouTube channel. Subscribe to get alerts and sneak peeks on upcoming topics. Don't forget to like and share this podcast with your family and friends. Until next time, life is precious, and so are you.